Hello, traders, and welcome to another episode in the series of From Start to Finish. So I've got this right here. This was a saying of my father's, buckle up, buttercup. So that's for two reasons. One, if you take a look at our market, I mean, this is a pretty sizable drop from, well, all the way up to 4,600 down to, right around 43.20, 43.30, somewhere in that range. So that in itself is pretty sizable, but just look at the last 2 days. That's a big move in a couple of days. So let me slide this out of the way, and we have come into what I might call a little bit of a support area, hopefully. Of course, news can blast through any support area. But right now, I'm envisioning the likelihood of some potential support here. However, I want to walk through the second reason for the buckle up buttercup is buckle up because there's a lot to learn in this trade. This is a trade that I make. I'm in this trade live, and I'm making the exact moves, and I'm sharing with everyone here. So, usually butterflies are pretty smooth, easy. A lot of times you don't even have to adjust them. You put them on, they got a nice wide range on them, and you take them off. And we actually did that on 5 of the 30 butterflies we have here. As you'll see, we did thin this trade initially when it was up, a couple $1,000 somewhere in that range. Now, let's just take a look though. We started this trade on the 13th, I believe it was, if I'm not mistaken. Now let's come to the original trade. So this is the original trade as it was put on September 13th. So if we look at our market on September 13th, we were right up in here, so 44.76. So, and at the time I was thinking, yeah, we might range between 4,500 and maybe drop down here into the, 4,400 range, something like that. So I built my trade with that initial general range in mind. And if we go back and look at that original trade, I mean, this was the original trade. It was just this butterfly right here. And that trade would have run through, it would have easily handled, 4,500 down to 4,400. No real problem in that. So that's what that trade was originally set up to do. So it was a butterfly, a flat butterfly with a long call because, if the market broke out and ran to the upside, I didn't want this butterfly losing to the upside. So that was the very original trade. And I will put in the link down below, I'll put a link to the video of that trade where I started this. Now keep in mind, this is now the 4th adjustment on this trade. I'm going to walk you through all 4 of those. So on the 13th, that was the position. The market was right up in here somewhere. And if the market had not moved, if we were still in that same general market range, this trade would be up about $4,600 or so. However, we've had this huge sell-off, and if I had not done anything to this trade from the start, I have done things to it, and you'll see what I've done to it. Had I not done anything to it, this trade would be down about $5,100 right now. And you can see that it's also out in a place here where it would be decaying, and here, a few weeks from now, to be down at this dashed line, and then a few weeks after that, it'd be down at this dotted line and down $20-some thousand. So obviously, that's not what we want. And if I look at the delta here, you can see I'm very positive delta, which means that I have to have a sizable up move in order to make this trade work if I were still in this configuration. Again, I'm not. And then also, theta is hugely negative, meaning that I'm paying, if I were in this position, I'd be paying about $146 a day to hold on to this position, and that number accelerates the closer you get to expiration. So those are important numbers to remember, and then if you march time forward from September 13th, and we march forward here to the 15th. Now on the 15th, the market was way up in here somewhere. We had a little bit of decay, and I closed out of the 30 butterflies I had on here. I closed out 5 of them, locking in profit. So at that point, this trade was up, you know, a couple $1,000, somewhere in that general range. And I locked a little profit in, and it was still set up so that if the market ripped to the upside, I'd still be in good shape because I had that long call in there. If the market ripped to the downside, yeah, that was going to hurt a little bit. But I wasn't expecting quite the rip that we had. This position right now, if I were still in this position, which again, I'm not, we had another adjustment as the market started to sell off, and I'll show you how that impacted this trade. But had I not adjusted from this position, we would be down $4,600 in the trade or so today. But you'll also remember just a few days ago, and this was on September 21st, or excuse me, no, the 21st is today. On the 19th, I sold off the long call. So remember, we had that long call that was kind of keeping the line up over here on this side. As we sold off down further, at that point, we were right down around to the left side of the tent here. And so I needed to neutralize my delta. Again, go back and look through this series of YouTube videos on this, and you'll see each one of these progressions and how I lay it out. And in that particular case, we needed to also remove positive delta, and we wanted to increase our theta decay. So at that point, you can see that these numbers are significantly less than what they would be if this position was still in its original configuration. But they're still not good given where the market is down here. The market, again, has sold off considerably. So as of the end of the day today, this position that I am in went from being up $1,500, $1,600 to down $2,800. Okay, and again, this was a pretty darn big move today. So from here, what is my objective? What is it I need to do to manage this trade and attempt to work it hopefully back to a nicely profitable state, which can't always be done. But I feel like it can be done in this case, and I'm going to show you how I propose that, well, not propose, how I am doing it. Not that that's the only way. There's lots of ways to do this. But the things that I have to do in this trade right now is I'm a delta neutral trader. I got to knock this delta way back. And I also need to be positive theta for me. Theta is money coming to me in time decay. Right now, when our market's all the way down here, I am paying every day to hang on to this trade. I don't want to be paying to hang on to a trade. I want somebody to be paying me to hang on to this trade. So what I have to do here is I have to get my theta back to positive, reduce my delta, and I want to, in order to get theta positive, I somehow have to get this back under a tent. There's a couple ways I could do that. I could sell off this entire butterfly and roll it back to this point, which isn't a bad option. It's easier to do earlier in the trade, but it's very commission intensive. A lot of commissions involved in that. Probably a few $100s in commissions to make that move. And that's if you got a good rate on your commissions. So probably not what I want to do. So let me show you what I chose to do on this trade here today. And again, this is the buckle up buttercup part because there's a lot of moving parts to this thing. So you can see I've now built out a structure that looks kind of weird. It's not just a butterfly. This is a butterfly. This part is a condor. And if we take a look now at our numbers, well, my delta is now flat. Remember before here, my delta was a positive 62. If I go all the way back to the original configuration, I'd be positive 87. In the very original configuration, had I never adjusted it, I would be down $146 a day in theta. In the current configuration that I'm in here today, I'm down $70 a day in theta. But in my new configuration, the adjustment that I made today, I'm positive $267 a day in theta. And again, theta numbers accelerate over time. So If the market, as we get closer to expiration, today this is 267, you get down to the last few days of expiration, and this is going to decay at the rate of $600, $700, $800, $900 a day. Now, at the same time, my gamma, the steepness of the curve, gets higher, which makes it a little more volatile to hang on to. I don't like to be in that position that close to expiration. But the fact that I'm now 267 a day positive, in a week's time or so, a couple of weeks' time, I can wipe out a lot of this current loss if the market doesn't do something, crazy on me again. So this is the position I'm in now. So how did I get into this position? Well, what I did was I had 35 of these short 4480 puts. I bought back 15 of them. So I came in and I bought 15 of these things back, leaving me with just 25 of them at that point. Or excuse me, no, that's the volume. Let's see. I bought back 15 of them. Somewhere here it would show me. It shows me right here. So I scaled 35 of those out, and then I also scaled 35 of these out. So basically I bought 15 Okay, so let's look at how I scaled this, because this gets kind of confusing here. So basically, I got out of 15 of my 4480 strikes. So again, prior to this, let me just skip back here. We were in this position where we had this butterfly. We had 25 of these. We had 50 of these, we had 25 of these, okay? So that was my butterfly configuration right here. But what I'm going to do is I'm going to come in and I'm going to basically buy back 15 of these, sell 15 of these, and then I'm going to come down lower, I'm going to sell 15, and then I'm going to buy 15, basically turning that into a condor. So here's what that looks like. So I came in here, and in this particular case, we were short these, so I bought back 15 of them, and then I sold 15 of the 25 I had here. So this was closing out a portion of an existing trade. So basically taking this, reducing this side of the butterfly. In fact, I can probably show you that by excluding these two for a second. I think that should work. Yeah, so basically I just bought back this whole side of the butterfly. But you can see if I did just that, well, the market, I'd do fine in this trade if the market stayed down here. I mean, if the market stayed below this point in the butterfly, I'd be fine. But if we get one of these strong rip-up days, let's just say that they say, you know what, we've settled the debt ceiling and we're all happy in Washington now. Well, this market's going to rip up and I'm going to be down a chunk of money. I don't want that. Again, I don't want to be negative 86 delta. I'm a delta neutral trader. I want to get back to a more neutral type of trade. So the way to do that after I've thinned out this side of my butterfly is I now come in and I sell a vertical on this side where I'm selling 15 4330 puts. And so let's just include those. So I've done that. But I now don't want this massive downside risk. I need to protect my downside because right now I just have naked short strikes here. So I come in and I buy additional insurance on the downside, and I bought that 30 points away. So that puts me in this position where I essentially have about the same total risk that I had in this trade from the start. I still have about $20,000, a little over $20,000 in risk in this trade. But what I've done is I've widened out my tent considerably now. And I've flattened out my delta, and I'm positive theta. So those are all the things that I'm looking to have happen. So what happens from here, if the market moves up? So let me just come in here, and if the market were to move up, one of the things that's going to happen is volatility will drop. That's normally how that works. Not 100% of the time, but 95% of the time, if the market moves up, volatility drops, fear drops. So if that were to happen, volatility drops, this trade starts to show some significant profit, again, fairly quickly. And if the market moves up and volatility drops, this trade could be up to, $2,000, $3,000, $4,000 profit in a few days. Now, right now, I haven't even moved my day count forward. I've just simply dropped out some volatility. So let's just say that volatility, I think right now is 14 point something on this reading. So let's just say volatility drops a couple percent. So it drops down to 12 or whatever in that range. So that's going to put this position up. But also what would likely happen at the same time is a couple days have probably passed as well. So we march, a few days by and volatility drops, and then volatility hopefully drops a little bit further. So this trade could, if the market stabilizes and or the market starts to move back up, this trade could gain back some profitability fairly quickly. And of course, that's what I'm counting on. That's why I've chosen to leave this trade open. Now, I'm going to take this same time while I have you here. I get the question a lot on a trade like this. Well, where do you stop out? Okay, I will tell you that when I trade options, I do not trade with stops, specifically mechanical stops. If I'm trading stock, it's easy to put in an order that says, if the SPY goes below this, take me out. And the bid-ask spread's very, very tight on that. And so if I say to sell out of my SPY position at 430 and SPY drops to 429.99, I'm probably going to get filled at 429.97. Not an issue at all. Good use for a stop if you're going to use one. So the way I structure my trades is that I don't use a stop in an options trade. Think about this for just a second. The bid-ask spread in options tends to be quite a bit wider to begin with. And here I'm dealing with, 25, 35, and 10. So there's 50, 60. I'm dealing with 90 legs in this trade. If the bid-ask spread is $1 wide, which is not unusual, it would easily be more than $1 wide, particularly if the market is moving quickly, and you've got, call it a $2 wide spread on 90 options, that's a massive amount of money. And if a stop is triggered, if I've got a stop set that says, if the market goes below 4,300, take me out, well, it's going to put out, in most cases, a market order. And if it puts out a market order, I am going to get hugely taken advantage of in that situation because of those wide bid-ask spreads. And the fact that I get a fill on that trade, I could lose $6,000-$7,000 or more in just slippage. So I choose to manage my trades, doing what I did here. And as you can see here, if the market were to go from 4,300, and drop over the next day or two down to 4,200, well, yeah, that's going to be sizable. But I would adjust through that too. There's other things that I can do, like what I did here, to adjust that trade to keep my tent over the top of the market to where theta decay is working in my favor. And some of these trades, they get to the point where, I may never get back to break even on that trade. I just might not. If this were to happen tomorrow, if we were to drop another 100 points, I'd go in here, I'd manage this, I'd adjust it. But at that point, I'm adjusting it with the intent of keeping my loss to a minimum. I'm not adjusting it with the intent of making, 10, 15, 20, 25% on the trade at that point. It could still happen, but that's not my goal anymore. The more times you have to adjust one of these trades, from my perspective, the lower I have to set my expectations as far as a return. So that's the bad part of all this. The good part of this stuff is, and if you're not aware of this, you need to study up on butterflies and be aware of it. The good part of it is, as volatility increases, when you put on new butterfly trades, your reward to risk is going to be significantly better in a butterfly than it would be if you put on a butterfly trade in a low volatility environment. That's kind of one of the biggest things that I like to share with traders, is that butterflies are a high volatility type of trade. They're really good. You get a great reward to risk when you do that. And I think I've illustrated that a number of times as well in the different YouTube videos where I've showed, a butterfly in low volatility versus high volatility, and how it costs you a lot less to enter in high volatility. And when it costs you less to enter, you've got more potential gain you can make in the trade. So this was long. I know it was long, but there's a lot to learn in this trade. So I strongly suggest that you go back and watch the prior, I believe it's 3 videos, where I opened this trade, had the first adjustment, then the second adjustment, and brings you up to today. Today's adjustment is by far the most complex adjustment. But again, there's a lot to digest in here. And keep in mind, the adjustments that I've made here, these are somewhat common adjustments for butterflies. There's about, I don't know, probably 5 to 6 somewhat standard adjustments a person might consider if the market rips up. And there's probably about 6 to 10 different types of adjustments someone consider if the market went down. And all of that depends on how long you've been in the trade, how close you are to expiration, what is the volatility at the time that you're going to make your adjustment. All of those things kind of come into play. So it's not a super simple recipe of if this, do this. There's a little bit of an art to it. There's fundamentals that people need to know and understand. But once you get beyond those fundamentals, then there's a little bit of an art that comes into it, or a skill that gets developed over time. So we'll see where this trade ends up. I don't know. This could be one of the first losers I've had in a while of a butterfly trade. I don't feel real bad about it yet. Right now, I'm still okay with where I'm at, even though it gave back a decent chunk of money today. But I feel like we're coming into maybe an area of support. If we do get that support, we get a little bounce, or we get a little decrease in volatility here, again, this trade's going to start to improve very, very rapidly. That's what I'm going to be looking for. So that's it for now. Again, thanks for sticking with me. And I know it's a lot here. If you didn't get all this, you didn't understand it yet, go back to some of the more basic trades and look through those, and then circle back to this one, in a few weeks after you've kind of digested some of the other stuff, because this is very complex here. I'll be the first to admit it. Take care, everybody.